Hello everyone. I will cover chapter 9 in this lecture. The chapter is about market efficiency and behavioral finance. These are the concepts that we will cover in this chapter. So we start with market efficiency. So market efficiency predicts random walk hypothesis. This hypothesis means that stock prices are not uh, trending in neat patterns, rather they are largely unpredictable. This happens because the market is highly efficient and it responds to any new information about the stock. So we look at an example. So this is the quarterly revenues for Walmart over a period of few years. So we notice that in the fourth quarter of every year, the sales goes up, primarily due to the holiday season. So we expect that during the fourth quarter of every year, the stock prices should also increase substantially because of good news about the company's business. What we notice is the stock price does not move in sync with the sales movement. The reason being that the market is efficient. So the stock market has already taken into account that every fourth quarter the sales will rise. So there is no new information every year, because of which the stock price does not rise in the fourth quarter. So what is the implication of efficient market hypothesis? So it says that the stock market incorporates any new information quickly into the stock price, because of which investors cannot expect to earn abnormal returns on a long-term basis. So what is abnormal return? It is the difference between actual return and expected return. Expected return is calculated using the capital asset pricing model, which says that expected return is risk-free rate plus risk premium. And risk premium is stock beta into the difference of market rate and risk-free rate. So it is not possible to earn abnormal returns or alpha on a continuing basis. So what are the different forms of market efficiency? So we have three forms: weak form efficiency, semi-strong form of efficiency, and strong form of efficiency. We'll look into each of them in more details. The first one is weak form efficiency. So this hypothesis states that the stock price trends cannot be predicted based on historical data, and therefore stock prices move at random. So the stock price does not the stock price will incorporate any new information quickly, and its effect will not persist, because of which we cannot use past data to predict the future stock trends. Then we look at a semi-strong form of efficiency. It says that investors cannot earn abnormally high returns using publicly available information. The reason being that the publicly available information is available to all investors, and even if there is any price anomaly, they will use the information to buy and sell the stock, and that anomaly will gradually be reduced. So the actual return will gradually uh, be similar to the expected return. Strong form of efficiency means that no information, whether public or private, allows the investor to earn consistently higher returns than expected. So this plot is a proof of semi-strong form of efficiency. So what we notice is there is a positive announcement about a company that which happens on day zero. So there is some uh, abnormal return possible a day or two after the announcement. Whereas if we look at days before the announcement as well as several days after the announcement, on average, there is no abnormal return possible. So however, uh, because a new information comes on day zero, in this case, it's positive. So it leads to positive abnormal returns for 1 or 2 days. After that, the stock market has already taken into account the new information and it no longer has an impact on the stock price. So this is an example of semi-strong form of efficiency. So related to market efficiency is the concept of arbitrage. It means that as an investor, I will try to buy and sell the same asset at different prices. So this will help me to earn an instant and risk-free profit. But in real world, it is not possible because an asset may be trading in different markets. And even if there is any price difference of the same asset in different markets, people will try to exploit the arbitrage opportunity. That is, they will try to buy from the market where the price is low and they will try to sell it in a market where the price is high. Since many investors will try to exploit this opportunity, it will gradually bring both the prices, gradually bring prices in both markets to similar levels, and the arbitrage opportunity would be lost. Again, this shows that arbitrage is not possible because markets are efficient. Available information, any available information is incorporated in stock price and it does not allow abnormal high returns. But there are certain observations which contradict market efficiency. These are called market anomaly. One is calendar effect. So what we notice is that during the month of January, stock returns increase substantially, and it happens year on year. So this is a persistent uh, effect which helps to earn abnormal high returns for a period of time. One of the reasons could be that in December, many investors want to sell their loss-making investments so that they can uh, use the realized losses for tax benefits, because of which prices go down in December, and after some time the prices again come back to normal, which shows in the form of positive returns. Another market anomaly is the small firm effect. So in this case, we see that small firms tend to earn positive abnormal returns. And this abnormal high return is present even after adjusting their expected returns for the high amount of risk. And this is seen in different markets, not only in the US stock markets. Another example of anomaly is the post-earnings announcement drift. So what happens is once there is a negative or a positive earnings announcement, there is either a spike or there is a decline in the stock prices. Now this decline or the rise continues for a considerable period of time. So we consider that any positive or negative new announcement leads to a lingering effect, which is known as the post-earnings announcement drift. Ideally, the positive or negative announcement should lead to a few days of abnormally positive returns or abnormally negative returns. After that, abnormal returns would not be possible. But in this case, we see that positive returns or negative returns tend to persist. So this is a graphical depiction of a post-earnings announcement drift. Even just after day zero, there is a spike or there is a decline, but it does not come back to the abnormal returns do not come back to zero, but it keeps persisting. Another example of market anomaly is value effect. So value stocks are those which have low P by E ratio or market to book ratios. On average, they outperform stocks with high PE or market to book ratios. The ones with high ratios are known as growth stocks. So this effect of value stocks performing growth stocks is persistent in different stock markets, not only in the US stock market. So what could be the possible explanation for such anomalies? So one reason could be that the stocks are actually more riskier. So they demand high returns for the actual higher risk. Then some of the anomalies may just happen by chance and they are not likely to persist over time. And another reason for these market anomalies is behavioral finance. It says that individual investors may have biases because of which they may continue to do mistakes in their investment decisions. And this opens up opportunity for abnormal high returns for other investors. So we now move into behavioral finance, which is in contradiction to efficient markets hypothesis. So behavioral finance looks at the reasons for market anomalies and it tries to explain them from the perspective of cognitive psychology. So, for example, an individual investor may suffer from overconfidence. So the investor will overestimate their ability to pick stocks and they underestimate their ability to, and they will underestimate the risk associated with those stocks. So their investment decisions may not be correct. Self-attribution bias means the investor will take credit for success and they will blame factors out of their control for failures, because of which, again, they may not take optimal investment decisions. They may trade more frequently, which leads to higher transaction costs and lower returns. Loss aversion is another bias amongst individuals. It means that we become risk averse when we face gains. That is, we want to capitalize or realize the gains. We become more risk seeking when we face losses. That is, we want to persist with the loss in the anticipation that the loss will turn around and it will lead to profits. So because of this, when we see stock price rising, some investors may want to sell off the stock and earn profits. Whereas if the stock price is falling and they are suffering losses, they may want to hold on to those stocks and hope that the stock price will rebound and they will be able to recover their losses. Representativeness is a cognitive bias which makes it difficult for people to think about randomness in outcomes. So they may sometimes overreact. So they think that a string of good performance will likely lead to similar performance in future. They have, if they notice a mutual fund to have performed well in the past, they expect good performance to continue in future and they may invest in the mutual fund. Similarly, top management in a company may also suffer from representativeness. They may look at a competitor which is doing well and would like to acquire it. They hope that the good performance of the competitor will continue even after the acquisition. So this is an example of overreaction. The other example is underreaction. So investors may not react to any new relevant information. That could explain the post-earnings announcement drift. So whenever a good news comes, some investors may not quickly react to that good news and they may start buying the stock at a later point of time. As they keep buying, as more investors keep buying later into future, the positive returns keeps persisting. Similar explanation can be given for a negative announcement. It leads to a decline. Many investors understand the importance of the negative news and they start selling the stock much later after the announcement, because of which the price decline keeps persisting. Narrow framing means investors are not able to see the bigger picture and they analyze a situation in isolation. So this leads to a problem of asset allocation. I may want to diversify across different assets. So I invest in different assets. It may so happen that the assets that I have selected actually do not lead to good diversification. But I use a very simple formula that if I'm investing across different assets, I'm doing diversification. So this is an investment decision based on narrow framing, which may not always lead to uh, proper diversification. So there is a similar example in the textbook. Belief perseverance is another bias where investors tend to ignore information that conflict with their beliefs or their preconceived notions. So if they believe a stock is a good investment, they will discount any news which shows that there are troubles with the company. In some cases, they may not even gather new information in the apprehension that it will contradict their preconceived notion. Anchoring is also a bias among individuals where we place undue weight on information available currently. So investors' future market returns. Investors' estimate of future market returns is heavily based on the market's recent uh, past returns. So if the market has done well in the recent past, we would give more importance to that information and expect that, that if invested in that market, we will earn higher returns as before. Familiarity bias means we tend to invest in assets which we are familiar with, even if those investments are not a good decision. Again, that leads to a problem of insufficient or poor diversification. So what are the implications of behavioral finance in case of security analysis or security valuation? So behavioral finance helps us to identify different psychological factors which leads to investor taking wrong investment decisions. These wrong decisions may contribute to some predictable patterns in stock prices, and other investors can focus on these stock patterns and try to earn above normal returns. So this is the implication of behavioral finance. So these are some of the best practices that an investor can adopt in order to reduce their biases, the different biases that we have discussed so far. This way, they will be able to take more optimal decisions and not create abnormal high returns for other investors. So that's all in this lecture. I will continue with the rest of the chapter in the next lecture. Thank you.